What if I told you that just 3 ETFs could make you wealthy over time without picking a single stock, timing the market, or spending hours researching companies? It sounds way too simple, right? But that's exactly what some of the most successful long-term investors have done for decades, and it all started with one legendary man, Jack Bogle. In this video, I'm going to show you and John Bogle's original 3 ETF portfolio, how it works, what kind of returns it actually delivers, and why it needs an upgrade for today's economy. Then I'll show you my modern 3 ETF version of Jack Bogle's portfolio, break down its logic, and show you the 30-year projections. And in the end, I'll compare both the classic Bogle portfolio and the modern version side by side and show you how the modern take can potentially double the returns, closing in on $1 million portfolio that could pay around $5,000 a month in dividend income. All of that just from a $10 daily investment. Now, before we talk about my modern version, we have to start with the legend who started it all, Jack Bogle. Jack Bogle founded Vanguard, and he changed investing forever. His idea was simple but revolutionary. Instead of trying to beat the market, just own the whole thing and let time, compounding, and consistency do the work for you. He created what's known as the 3-fund portfolio, and it became the foundation of long-term, stress-free investing. Here's how it works. You hold just 3 ETFs, one for US stocks, one for international stocks, and one for bonds. That's it. With those 3, you automatically own thousands of companies across the world. You're diversified across sectors and countries, and you get a built-in balance between growth and stability. No guessing the next Tesla, no chasing hot stocks, just steady growth that compounds over decades. It's investing made so simple that almost anyone can do it and still end up wealthy. So, how has it stood the test of time? At its core, it's built around 3 simple pieces. First, you have the Vanguard Total Stock Market ETF, or VTI. This one's the powerhouse. It owns every major U.S. company – Apple, Microsoft, Tesla, Coca-Cola, and thousands more. When the U.S. economy grows, this fund grows with it. It's the long-term wealth builder in your portfolio. Second, there's the Vanguard FTSE Developed Markets ETF, or VEA. This gives you exposure to international companies, big players in Europe, Japan, and other developed markets. It balances out your U.S. exposure so you're not putting all your eggs in one basket. And third, there's the Vanguard Total Bond Market ETF, or BND. This is your safety net. Bonds are designed to bring stability, income, and a cushion when the stock market gets volatile. Together, these 3 funds are like a perfectly balanced team. VTI drives your growth, VEA gives you global diversification, and BND provides income and keeps you steady when markets swing. Think of it like a 3-legged stool. You've got one leg for growth, one for diversification, and one for safety. If you sit on just one leg, you're going to fall over. But with all 3, you're balanced, stable, and able to hold your ground long term. And that's exactly why this portfolio became a timeless favorite among investors. It's not flashy, it's not complicated, but it works. And it's helped millions of people build wealth the slow, steady, stress-free way. However, when you look closely at how these ETFs have performed in recent years, you'll notice something interesting. There's a little room for improvement. Before we see what kind of return you can expect from Bogle's portfolio, quick shout out to the sponsor of this video, Moomoo. If you've been investing through your bank or one of those bare-bones apps, this might be a good upgrade for you. Moomoo is a free platform that gives you real-time market data, advanced tools, and zero-commission trades all in one clean, easy-to-use app. New users right now can get up to $1,000 in NVIDIA stock just for opening an account and making a qualified deposit. The more you deposit, the more NVIDIA stock you earn. It starts at $20 for $100 and goes all the way up to $1,000 in stock if you deposit $50,000. That's on top of their usual promos. You still get 8.1% APY on uninvested cash, and yes, that cash is FDIC insured up to $1 million. You'll also get access to Morningstar research, analyst ratings, and premium news sources like the Wall Street Journal and Bloomberg. So if you want to check it out, the link is in the description and pinned comment. Even if you're just curious, the promos alone make it worth a look. So thanks again to Moomoo for supporting the channel. Now, let's get back to our video and talk about what the Bogle portfolio projections actually look like. If you invested just $10 a day, about the price of a coffee and a muffin, into Jack Bogle's classic 3 ETF portfolio, here's how the numbers play out. The portfolio is made up of 3 ETFs: VTI, the Vanguard Total Stock Market ETF, which makes up 50%, VEA, the Vanguard FTSE Developed Markets ETF, which makes up about 30%, and BND, the Vanguard Total Bond Market ETF, which makes up 20%. Each of these plays a specific role. VTI is your main growth driver, VEA brings in international exposure covering developed markets like Europe, Japan, and Australia, and BND is your income and safety hedge. When we look at their numbers, BND has a dividend yield of 3.81% with 6.85% dividend growth, though its share price actually declined slightly over time at negative 0.88%. VEA pays 2.79% with strong 11.18% dividend growth and 4.81% annual appreciation. And VTI, the U.S. core, offers a 1.13% yield, 5.45% dividend growth, and 11.94% yearly price appreciation. Blending all of that together, the portfolio as a whole gives you a 2.16% dividend yield, 7.45% dividend growth, and about 7.24% annual price appreciation. That's pretty balanced, not explosive, but steady and reliable. Now, if you invested that $10 a day and just stayed consistent, after 1 year, you'd have about $3,650 invested. After 10 years, your portfolio is projected to be around $56,608. 20 years in, it's projected to be roughly $196,639, and after 30 years, the portfolio would grow to about $544,947. By year 30, that same portfolio is projected to be paying you about $11,364 in annual dividend income, or about $947 a month in passive dividends. But here's the catch. While this strategy is still solid, parts of it haven't aged well. In a couple of minutes, I'll show you an upgraded, modern version of the Bogle 3 ETF portfolio. And at the end, I'll compare both the classic Bogle portfolio and the modern version side by side and show you how this modern approach can potentially double the returns, closing in on $1 million portfolio that could pay around $5,000 a month in dividend income. But before I show you the upgraded version, let's talk about why the original Bogle portfolio, as brilliant as it is, needed a refresh. When Jack Bogle created his 3-fund strategy decades ago, bonds were paying 5 to 6% a year, and international markets were growing quickly. That mix made perfect sense back then, but the world looks very different today. First, bonds don't deliver the same protection or income anymore. The BND ETF has averaged less than 2% over the last decade, and that's barely keeping up with inflation. And only recently it managed to get up to around a 3 to 4% range. Second, the international ETF, VEA, has underperformed the U.S. market for almost 15 years. U.S. companies like Apple, Microsoft, and Google are already global, so you're getting worldwide exposure without needing a separate international fund. And third, a new generation of ETFs has entered the game that combines strong dividends with solid growth. So instead of adding complexity, I kept Bogle's 3-fund simplicity but updated the building blocks to fit the modern market. Let me show you what the modern 3 ETF portfolio looks like and how it fixes every weakness of the original. So here's how I upgraded Jack Bogle's classic idea for today's market. I didn't reinvent the wheel, I just swapped out the older parts for newer, higher performing ones that match how the world works now. My modern 3 ETF portfolio keeps the exact same structure: one core fund for growth, one for income, and one for diversification. First, the foundation, Vanguard S&P 500 ETF, about 40% of the portfolio. This is your anchor. It owns the 500 largest U.S. companies, Apple, Microsoft, Tesla, and has averaged strong returns for decades. It's simple, broad, and proven. Second, the income engine, the Schwab U.S. Dividend Equity ETF, or SCHD, about 30%. This replaces bonds. Instead of earning 1 or 2%, SCHD pays real dividends around 3.9%, and those payments keep growing 10% a year. That's steady income plus growth. And third, global quality, the iShares International Equity Factor ETF, or INTF, the final 30%. This gives smart international exposure, but only to high-quality, financially strong companies. So you stay globally diversified without sacrificing performance. Still just 3 ETFs, all low cost, all long term, but now each one pulls more weight, more growth, more dividends, more compounding. All right, so let's talk about how this modern 3 ETF portfolio actually performs when we put real numbers behind it. If you invested the same $10 a day every single day into this upgraded portfolio, here's what happens over time. When you blend all 3 together, the upgraded portfolio averages a 2.46% dividend yield, a 10-year dividend growth rate of 11.45%, and an annual share price appreciation of 7.71%. Now here's what that means for long-term investors. After 1 year, you'd have invested $3,650. After 10 years, the portfolio is projected to reach $60,454. After 20 years, roughly $251,043, and after 30 years, your total portfolio value would reach around $984,432. By year 30, this portfolio would be paying approximately $60,864 per year in dividends, or about $5,072 every single month, completely passive. Now let's compare it directly to Jack Bogle's original portfolio and see how massive the difference really is. Let's put them side by side. If you invested just $10 a day every day and stayed consistent for 30 years, the classic Jack Bogle 3 ETF portfolio would grow to about $544,947. It's simple, effective, and completely stress-free. And by year 30, it would be paying you around $11,364 per year in dividends, which comes out to roughly $947 every single month in passive income. This is good, but compared to the modern version, the upgraded 3 ETF portfolio results are on a completely different level. After 30 years, this updated version compounds into roughly $984,432, almost double the value of the original portfolio. And here's the most exciting part: by year 30, it's paying around $60,864 per year in dividends, which is about $5,072 every single month, 5 times the passive income of the original strategy. What's happening here is simple but powerful. ETFs like SCHD and INTF grow their dividends much faster. SCHD at 10.43% and INTF at 19.36%. And that creates a compounding snowball effect. Your dividends buy more shares, those shares pay larger dividends, and the entire portfolio accelerates faster every year. So in the end, the philosophy hasn't changed. It's still Jack Bogle's core idea: stay simple, stay diversified, and stay consistent. The difference is that this modern 3 ETF version takes that timeless formula and adapts it for today's world with higher compounding, stronger income, and a much faster path to financial freedom. Want more value? Click the video on the screen to find the best index fund that can turn a $100,000 investment into a $12 million portfolio.